New clients will often ask this. They'll say, what's equity? What is my equity and how do I actually access it? And it's a really good question. So I thought I'd use this example here to show you the difference between equity and accessible equity. What we've got here is a client that owns a property worth $800,000 and their existing loan is $450,000. Now, equity is essentially just the difference between what you owe and what the value of the property is. But for argument's sake, if we were to take out a $350,000 loan, your equity, then you'd be borrowing 100% of what the property is worth. And banks don't lend 100% of what the property is worth. They'll lend up to 95%, but in most cases you only want to access 80% of what the house is worth, because anything above 80% means you're going to be paying mortgage insurance and higher interest rates and things like that. So realistically, the maximum that you can take out is $190,000 against this $800,000 property. We're only borrowing 80% of the value, which means no mortgage insurance. So the actual equity, $350,000, is quite different to the accessible equity of $190,000. We also have a lot of clients come to us and say, I've got all of this equity in my house. How do I take it out? What's involved? It's mine. Why won't the bank give it to me? And it's a good question. If you're trying to access the equity in your property, someone has to pay you for it, right? And so essentially, if you sell the house, the purchaser is giving you cash, but then they get the house. When you want to access the equity from a bank, you're actually selling a portion of your house to the bank, essentially. So you could say, I want $50,000. And so bank give you $50,000 and now they own the extra $50,000 worth of your house, essentially. So that when you pay them out, when you sell the house, you clear that extra $50,000 debt. So accessing equity isn't just, being given the money that's available, like turning a solid into a liquid asset. You're actually borrowing money from the bank in exchange for ownership in your property. Now, there are a few things that you can use this equity for. Quite a few different things that you can use this equity for. Maybe you need to clear some debts. You've got some credit card debt. You might want to buy a new car or need a new family car. You might even want to just go on a holiday. All of these purposes are acceptable. You can take cash out for all of them, renovate the house even, as long as you're not borrowing more than 80% of the property value, or a little bit more if you're happy to pay mortgage insurance and a higher rate. But you can also use the equity to purchase another property, maybe a new home or an investment. And so I wanted to talk a little bit about how that works today as well. Because if we were to purchase a new investment property, for instance, for $600,000, what we need to cover is the costs associated with that purchase. And ideally, we're covering a 20% deposit as well, so that we're not paying mortgage insurance on the purchase. Now, to cover all of that, we're getting down to an 80% lend on this purchase. We need $156,000. And when we contribute that from equity, we're then borrowing, $480,000. So what people need to keep in mind is that when we're using equity as a deposit for a purchase, we need to prove that we can afford to borrow not just the $480,000 on this new purchase, but we can afford to borrow this $156,000 as well. So the way that would essentially look, you can do this in a few different ways, but what we like to structure is putting the 80% lend against the new property and putting that $156,000 against the existing property. And what this does is it keeps things nice and clean. We don't have these two properties crossing together, so that if you wanted to sell one or the other, the bank needs to review what debts are left. Do we have enough equity in the remaining property? How does it all look? It's nice and clean. If you sell investment, you can clear this $480,000. And if there's enough money left, you can clear the remaining debt as well. Ideally, there is. On the flip side, if you sell your home, you don't need to clear that whole investment debt either. You need to clear this, or hope that there's enough equity in the investment to then move that 156 over there as well. So it keeps things nice and clean. And because this loan here is an investment loan, you're using it for investment purposes, you can treat that as a tax deductible debt as well. Now, obviously how tax deductible that is always changing. Can you deduct it against your personal income tax? Can you deduct it against just the income from that property? It's always changing, but it is a tax deductible debt at the time of this recording. So hopefully that explains what equity is and how it kind of works, how you can access it. If you've got some equity that you're looking to access, you need to clear some debts, maybe you just need a holiday, be sure to reach out, give me a call in the office. Would love to help.